Hello, everybody. Ed Yardeni here in my home office in Long Island. Hope you folks had a good weekend and aren't suffering too much in this volatile stock market we're experiencing this year. It looks like it's going to turn out to be a year for capital preservation as opposed to trying to get things right to the upside. So the volatility continues. I know right now, after the sell-off at the end of last week, it feels more like a bear market, but I think it's going to be a volatile market. I do think that there'll be some kind of rebound here. Let me just turn this thing off. I do think there'll be some sort of rebound here, given that sentiment has turned so bearish here in the past few weeks. The bull-bear ratio of investors' intelligence is back under 1. The AAII sentiment indicators are extremely bearish. And so sentiment sort of seems to be primed for some bounce back in this market. And meanwhile, I think the earnings outlook remains pretty good. And don't forget that stocks are an inflation hedge. And we are seeing that analysts continue to raise their earnings expectations. Partly because the economy is still doing reasonably well. You saw housing starts were quite strong. And part of that's because inflation is getting pushed through into earnings. So again, stocks are a good inflation hedge. Well, what got everybody unsettled last week clearly was on Thursday. I'm looking at my notes here. Powell gave some remarks at an IMF panel discussion. And he didn't say anything about trying to engineer a soft landing. Instead, he sounded more hawkish than ever. He asserted that, quote, getting inflation back to the 2% goal, unquote, is a key policy imperative right now. He added it is, quote, absolutely essential to get price stability, unquote. So in my book, Fed Watching for Fun and Profit, that I wrote back in 2020, the chapter on Powell is called Powell, the Pragmatic Pivoter. And he certainly has done a lot of pivots in the time that he's been head of the Fed. And the latest pivot is to go from being uber liberal, very concerned about the labor market, telling us that he's, when he drives from home to his office, he sees encampments of homeless people, and he's very upset about that, and he'd like monetary policy to make things better for everybody. And now he's talking about being laser focused on bringing back price stability. And his remarks clearly made it very clear that he's talking about 50 basis points as the increase in the Fed funds rate that'll they'll be pushing for in May, that they will implement in May, and left it wide open for more similar increases in coming FOMC meetings. Maybe instead of calling this thing Fed Watching for Fun and Profit, I should have called it Don't Fight the Fed, which is Marty Zweig's famous insight into the Fed. It's really been that simple. When we think back about the past several years, the Fed has clearly been a key driver of the stock market and the bond market. Who knows, maybe if I have any free time, I'll update the book, and with the information that's occurred since I wrote the book, and name it Fed Watching for Fed Watching, but I think I'll rename it Don't Fight the Fed. And maybe the long title is, for now anyways, that's relevant, is Don't Fight the Fed when the Fed is fighting inflation. But look, I still am not convinced that this is going to end in a recession. Consumers are in very good shape. Corporations are in excellent shape. We reviewed the corporate sector recently. I guess if we're going to have some problems, it could be overseas. Certainly, Europe looks like it's got a pretty high chance of a recession. And now we've got the zero COVID policy in China shutting down in lockdowns a lot of that country. So there's certainly recessionary forces that are going to have an impact on the U.S. economy. And yet, I think we are going to still continue to grow. So hence, I conclude with the volatility will continue as as the markets continue to worry that the Fed's tightening will cause a recession. And as we get evidence that maybe that's not quite the case, so that's where the volatility comes from. Let's take a look at some of the charts that are relevant to our discussion today. So let me share the screen here. And let's focus on the market for starters. Clearly, this is what happened on Friday. We had a significant sell-off following Powell's comments on Thursday. So Thursday and Friday, especially Friday, we had a big drop. And clearly, earnings expectations don't change that quickly. So when the market moves that quickly to the downside or the upside, it's all a matter of valuation and what investors are willing to value the earnings expectations of analysts. There aren't too many alternative earnings estimates that investors can, in fact, discount other than consensus expectations of analysts. So if they don't agree with them and they think that the analysts are being too optimistic, then they can take a whack at the valuation multiple, which is what has happened here. So this is just another similar chart showing all the panic attacks we've had here. And I guess the question here is this a panic attack or is this the beginning of a bear market? And I'm still thinking more panic attack, concerns about the Fed causing a recession, but not in fact going into a recession. I will admit, and I've said, I think the odds of a recession have clearly increased. I have to be practical about it, pragmatic about it, realistic about it. And so now instead of 15% prior to the war in Ukraine, I'm thinking 30%. And after what happened at the end of last week, I was kind of having a discussion with some of my colleagues. Maybe it's time to raise it to 40%, but we're not going there yet based on the fundamentals we're seeing. So again, sentiment, the put-call ratio had a little spike here, and that may be a sign that there's some enough bearishness building up here to at least have some rally response. And then, of course, this bull-bear ratio is back under 1. I previously pointed out that in the past, whenever it's dropped below 1, it's been a pretty good buying opportunity. But looking back at the charts more carefully, it's pretty clear that while 1.0 or less is a great buying opportunity, it's not necessarily for traders, it's for long-term investors. And so I think we are creating some good opportunities here for investors to cherry pick some good values. But again, I'm writing a piece for Tuesday where Joe and I are speculating that there are a lot of leading indicators, but one of the leading indicators clearly is the valuation multiple, the forward PE, because analysts are really, really good at anticipating earnings during economic expansions. They don't do recessions very well. They don't do them really at all. When recessions hit, they come to that realization at the same time that it's making the headlines and we're all recognizing there was a recession. And that's when they really start to chop their earnings. I will say that they are really quite good at picking bottoms. When you start to see signs that forward earnings have bottomed, that usually is the bottom of the recession. But again, what's relevant to us right here is a recession outlook, and you don't want to rely on analyst consensus expectations for that. But on the other hand, investors tend to be pretty jittery, pretty emotional, nervous kind of folks in the market, in the sense that when they sense that a recession's coming or that there's some credit crunch coming and that could cause a recession, they react pretty quickly, and you see that in the valuation multiple. So as you can see, we've had in this chart we've had a bear market in this chart, 2008. We've had some bona fide corrections of 10 to 20%. And in those cases, you can see that what really comes in is the valuation multiple. And then what makes a correction different from a bear market is in corrections, it turns out that the fears of a recession were misguided. They were an exaggeration, and the earnings continued to go up. Earnings estimates by the analysts continue to go up. And investors came to the conclusion that they jumped the gun, and then the valuation multiple would pop right back up. So We saw that, remember that last taper tantrum, the previous taper tantrum that we had back in 2018, the PE multiples for the S&P 500 growth value, mega cap, they all took a dive and then they kind of rebounced right back. And then we had a correction here in, it wasn't a correction, it was a bear market that lasted all of a couple of months. And you can see that, again, we had this really big sell-off, but we kind of view it more as a correction because it just didn't last long enough. And then, of course, we bounced right back when it was clear that the Fed was going to save the day with a tremendous amount of liquidity. Then we got a little bit too excited here. The mega caps went up to 38 forward PEs. The growth, the mega caps account for about half of the market cap of the growth. And you can see that that obviously impacted things. And then they've been kind of volatile, holding their own pretty well. But now we're taking the air out of some of these valuation multiples for the mega cap, and that's having an impact on growth. And that you can see the Friday action was basically the investors saying, well, it's nice to see that forward earnings, analyst expectations for this year and next year are an all-time record highs through the week of April 14th, I believe it is. But we're kind of losing our confidence in the ability of earnings to stay up. And so we're going to take that out of the valuation multiple. So again, the market's leading indicator, if you will, or indication of the risk of a recession is flashing a warning sign here, but there's so many other leading indicators that aren't pointing in that direction at all. Like the index of leading indicators continues to rise into record high territory. But let's move on here a little bit in the charts. Clearly, the issue for the market is the Fed's recognizing a little belatedly that they're way behind the inflation curve and that they have to catch up. And they've talked increasingly more hawkish. And as you can see, well, as I mentioned, Powell's talking about trying to get the inflation rate back to 2%. There's just no way that's going to happen anytime soon. If you look at the wage price rent spiral, you can see that with the wage growth tracker is up to 6%. So it's increased substantially. The total CPI is up to 8.5%. And rent inflation is up to 4.4%. That's the blue line. And while, as we've discussed before, I think there are some forces here that are going to moderate inflation. The offset is going to be rent inflation. And so I think that's very unlikely to happen, to get back down to 2% anytime soon. As I've shown you before, this is our current forecast trajectory for the headline personal consumption expenditure deflator. And you can see that we're counting on this thing to peak during the first half of the year, somewhere between 6 and 7%. And then we're expecting it to moderate down to 4 to 5%. And then next year, we think 3 to 4%. Now, clearly, if Powell really is delusional enough to believe that they can get it down to 2% in 2023, then we're not talking soft landing. We're talking about Volcker 2.0. And as a matter of fact, on Thursday, maybe another thing that unsettled the markets is on a video call, Powell also joined some sort of conference about Volcker in an academic setting and just declared that he was one of the greatest public servants of our era, which I happen to agree with. But maybe the market concluded that Powell was signaling that he was ready to do a Volcker. I just don't think that's very likely. And I think they are going to realize that there are some aspects of this inflation that are not monetary in nature. As you know, for over 10 years, they've been trying to get inflation up to 2%, up to, remember when we were here and they couldn't do it. And they kept thinking that they should be able to do it because after all, we all know inflation is a monetary phenomenon. And there were lots of other factors that suggested that was not the case. Well, we've previously discussed the 4 Ds, the 4 deflationary factors that explained why inflation stayed so low for so long. Now I'm renaming the 4Ds and calling them the 4DFs, the 4 deflationary forces. And then I'm arguing that the 4 deflationary forces have met their match in the 4 inflationary forces, IFs. And what are the inflationary forces? Well, to the extent that we're seeing deglobalization, that's a inflationary force. You can see in this chart, this is a chart of manufacturing production and manufacturing capacity in the US. And they were both going up in a pretty predictable growth rate, with the exception, of course, of volatility in production. But capacity was growing fairly solidly until China joined the World Trade Organization and manufacturing went overseas. And that was globalization. Globalization took factory jobs out of the United States, factory capacity out of the United States, and it kind of flatlined. But it meant that a lot of things were produced overseas in China, and the China price was imported by Amazon and Walmart. And now Amazon and Walmart are at sort of in the forefront of some of the pricing pressures, because they are raising wages and they are raising prices. So this is a kind of a quick history with some of the highlights of what it is that impacted the consumer price index over the years here. So Vietnam obviously had an impact. Walmart was, went public here, didn't have its disinflationary impact until here. And then Amazon goes public. But you can look at it on your own. And here we are now with deglobalization putting upward pressure on inflation. Another inflationary force is decarbonization. Won't spend a lot of time on that one, but the basic concept is the climate change activists have been fairly successful in driving up fossil fuel prices and creating shortages, to the extent that they've convinced politicians to shut down nuclear reactors in Germany, for example, and here in the United States to do everything they can to make it hard to move forward with fracking, or just to produce more oil and gas. And the result has been higher prices, and the climate activists think that's a good thing, because higher fossil fuel prices will force us all to buy electric cars, which is fine if we had $60,000 to $100,000 to buy these cars. And if we felt comfortable with the range that they have on one charge, and what happens if you get stuck in traffic on a highway and your battery is extremely low. Anyways, decarbonization is inflationary. The transition to a CO2-free world has been rushed, and as a result of that rush, we're seeing inflationary forces. Now, demography is one of the forces of disinflation. Older people tend to be less inflation prone, have in their behavior than younger people, but demographics can also have an inflationary consequences, which seems to be the case. So if we look at Japan, Japan has been sort of the role model for a country with geriatric demographics and how that keeps inflation down. And even now, if you look at the total inflation rate through March, it's only up 1.2%, and core is actually down 1.6%. But we're not Japan. Maybe that's a relevant model down the road. But for now, the labor shortages are turning out to be, the demographically related labor shortages are turning out to be inflationary. And you can see this is the age wave versus the inflation trend. And until now, the age wave was in fact the disinflationary force. So what is it that's making it inflationary now? Well, the shortage of labor around the world. Globalization was partly based on finding cheaper labor overseas, and that's becoming harder and harder. For world fertility rates in many parts have dropped below replacement of 2. And if it wasn't for India and Africa, these numbers would in fact be 2 or less right now. China just came out at 1.3, so they're well below 2. So there's a real slowdown in the working age population around the world. And you can see that we're down from about a little over 2% to now 1% growth in working age population, and that's going to continue to go down. So globalization, for the sake of trying to find cheaper labor, is kind of losing its mojo. And with all the factors that have militated against the globalization, Trump's trade wars, the pandemic, the Russian invasion of Ukraine, the sanctions against Russia, and now COVID in China, these are all factors that clearly are convincing a lot of businesses that globalization has got some real downside here. Just in case doesn't work in a deglobalized world, and you have to move towards you have to move to just in case from just in time. So here we got the civilian labor force growth in the U.S. growing extremely slowly. We've I want to jump that one. So where are we now? Well, I think that the Fed clearly was a major source of helicopter money. This is the Fed's holdings of U.S. Treasuries. This is the federal deficit. We can see the Fed's holdings of U.S. Treasuries have increased dramatically as a percent of total that's out there. But the bottom line is the Federal Reserve clearly was instrumental in causing the surge in inflation. And on top of all that, we saw some of these forces of deflation morph or at least be challenged by inflationary forces. And that's where we are right now. And the conclusion is that the Fed is certainly going to be raising interest rates. The valuation multiples in the market are getting hit right now. But I do believe that inflation is going to actually boost earnings, and that we're not going to have a recession. The consumer and the business sector, I think, are in pretty good shape. So to me, it adds up to be a volatile year, and I'm still in the correction camp as opposed to the bear market camp. Well, why don't we open it up to some questions? Let me wet my whistle here. So far, we've been lucky. None of my puppies have come in to ask for attention, though I think some of you like when they do so. Maybe they'll make an appearance. But I've got a few minutes here to take some questions. I've got a few right now. So Ed, we are in the business of making bets. Where do you stand between 4 DFs versus 4 IFs? Which will dominate in the next 3 years? That's from Scott. I think over the next 3 years, we're looking at the IFs dominating the DFs. The DFs had the deflationary forces had a great run from the early 1980s until just prior to the pandemic, or maybe the first year of the pandemic. Now the inflationary forces are giving them a good tug of war, and I think it's a tug of war. So I don't think that one or the other really prevails. And if you look at the history of inflation, and we've looked at it before, inflation tends to go up and then it tends to come down pretty quickly. Now, most of that is associated with recessions, and maybe that's the answer here. Is what will bring inflation down isn't this tug of war. The tug of war between DFs and IFs will be resolved by having a recession, or else it could do it the way I'm thinking, and that is we are going to see some moderation here up ahead in consumer durables, for example, and the offset will be rent inflation, and we're just going to live with higher inflation, 3 to 4%, without causing a recession. But after Powell's hawkishness on Thursday, obviously that's been we've lost some confidence in that kind of scenario, as we've seen in the market's behavior. Rick, global earnings revisions are now negative. U.S. earnings revisions are basically zero. Does this diminish some of your expectations for profit growth going forward? That's a good question. And the fact of the matter is that earnings do tend to get revised downwards during economic expansions. Analysts have a tendency to be too optimistic and then to have to lower their numbers. So it's not unusual to see downward earnings revisions, but I'm not seeing it in the analysts' the actual expectations for this year and next year. And then when we take the forward earnings, which is a time-weighted average of this year and next year, that's continuing to rise to record high territory. So I'm aware of the fact that we're in that part of the expansion where net earnings revisions, which tend to get revised up sharply during recoveries, then start to show downward revisions as the expansion continues. But as I said, the actual expectations, consensus expectations for this year and next year continue to rise to record highs. And again, I think they reflect not only that the economy is still growing, but they also reflect inflation. And the reason they reflect inflation is because companies are holding on to their profit margins. So when inflation boosts revenues, it also boosts earnings because companies are holding on to their profit margins. If the profit margins are really taking a dive here because costs were rising faster than they can be passed through into prices or offset by productivity, then we would see revenues growing faster than earnings and earnings starting to kind of sputter out. But that's just not what I'm seeing in the weekly data. Okay, Sean, how will quantitative tightening of 95 billion per month affect the yield curve? Well, I think the clear answer to that is if the Fed is not buying 95 billion per month, it could affect the long end to the extent that the Fed stops buying the long end. But then the reality is if they're just going to let everything kind of run off, then really what's running off is short-dated securities that have matured, and they're still holding on to the long end. But I think the shock of going from $210 billion per month in purchases by the Fed, which is what's been going on over the past year, to swinging the other way to $95 billion in running off the balance sheet, I think could have I think it already has had an impact on the yield curve. The yield curve's already, I think, discounted the fact that the Fed's just not going to be there buying securities, and quite the opposite, is going to be letting its balance sheet run off in the short maturities as they do mature. Let's see, Darren, how would you recommend sector positioning over the next 12 months? Well, I think energy still is a good hedge against inflation, and energy as a market cap share is still a remarkably small share of the S&P 500. So I think it's got the potential to continue to outperform. Financials, I still think make for good hedges against rising interest rates. They do benefit from widening interest margins. However, the relationship between the bond yield and the performance of the financials, as you know, hasn't been very good of late. It was doing pretty well last year, early this year, when we did in fact see when the bond yield went up, financials outperformed. That hasn't been the case in recent weeks. Nevertheless, I do think that on balance, it's a positive for their earnings. Then there's technology. Technology has gotten whacked here. The valuation multiples have come down. Maybe there's more downside as the market continues to respond to the Fed's hawkishness. But I think the earnings are going to come through for a lot of technologies that companies have to use in order to increase productivity in a world where labor shortages are a big problem. Let's see, Anurag, what is the cycle time for rent inflation and wage inflation to subside to normalcy, and what is normal? Good question. Well, I guess we could go back to the pre-pandemic period and see that normal for rent inflation was about 3.5%. And now, as I pointed out, we're already at 4.4 and going higher. And we know anecdotally that new leases around the country are going for 12 to 15%. That's an average. There's plenty of talk about and news about 35, 40, 50% increases, even doubling of rents I've heard in some cases. But those are on new leases, and the CPI and the consumption deflator reflect the average of all leases currently. So there's still leases that will be renewed over the next 24 months. that are going to reflect this recent surge in rent inflation. It seems to me that the surge in rent inflation for new leases just started at the beginning of this year, which really means that we probably, the answer to your question is at least 12 months and probably 24 months where new leases continue to put upward pressure on rents. Meanwhile, it's encouraging to see that multifamily housing construction is picking up. I mean, there will be a response in the housing market to these kind of rents. And so I do think that'll help to moderate things, but it's not going to happen anytime soon. So that's, say 12, 24 month kind of move here for rents. Wage inflation will largely depend on, it historically depends on the business cycle, but this time is different. What's different this time is we've got some chronic labor shortages. So wages continue to go up. And the risk for companies is that if they think they can continue to get away with passing all these costs, labor costs and other costs into prices, we may find that consumers really do start to have an issue with getting a big wage increase that's completely offset by big price increases. And so I think there is going to be a lot of pressure on companies to recognize that they can't just continue to pass through their cost increases, and they do really have to increase their productivity. And that's what I'm counting on to kind of save the day here on a longer term structural secular basis. I mean, look, I'll admit to you, the one sure way to solve all of these problems is just to have a recession. It doesn't have to be a long and nasty one. It could just be a garden variety recession. Recessions have a pretty good track record of bringing down price inflation and wage inflation. I'm not sure they're going to bring down rent inflation because people still have to live somewhere and there's still the supply-demand issue. And as I said, there is the structural issue in the labor market of labor shortages. Let's see, we've got Marshall here. Do you think a financial crisis of some sort may proceed and precipitate a recession? What would it take to derail the Fed's anti-inflation regime? Yeah, I mean, I'm writing about that again for tomorrow. Actually, we've addressed the issue numerous times. You know, when the people were kind of going crazy about the 10 to 2 year spread, we were arguing that that's just one of the many ways to slice and dice the yield curve. But the history of the yield curve, defined as the 10-year minus the Fed funds rate, shows that, in fact, what the yield curve does is when the Fed is raising interest rates, when it's tightening, the yield curve starts to anticipate that something will break. And that's when the yield curve stops widening and it starts flattening and it starts narrowing. I should say stops widening, it starts narrowing. And then something does break as the Fed continues to raise rates. You get a financial crisis, becomes a credit crunch, becomes a recession. This time around, there's a tremendous amount of liquidity left over from the past couple of years of ultra easy monetary and fiscal stimulus. There's still, again, $3 trillion in M2, exceeding its trend prior to the pandemic. A lot of that is in demand deposits. We know that corporations over the past 2 years raised something like over $2 trillion in the bond market at record low interest rates. So I just don't believe that something's going to break, but that's what the markets are all jittery about. Look, if there's going to be a recession here soon, it's going to be one of the most widely anticipated or feared recessions of all times. And if something does break, it will have been anticipated because everybody's waiting for something to break. But I'm not convinced that's likely to be the case here, given all that liquidity that's still in the system and given the good situations that I'm seeing in the income and balance sheet positions of consumers and businesses. Well, I've overstayed my welcome by about 3 minutes. I'd like to, out of respect to your time, and it is Monday, starting out the week. Look, have a very good week. I'm expecting to see some decent rebound here in the market on at least the negative sentiment. And who knows, maybe some of the earnings numbers up ahead here will also give the market some comfort here that we're not going straight into a recession. So again, have a good week.